Do you want to pay off your mortgage early, but you don't know where to start? Well, you are in the right place. There's a lot of debate about whether or not you should pay off your mortgage. It's true that an early mortgage payoff might not be for everyone, but it was definitely the right move for our family, and it might be exactly what your family finances need as well. So in this video, we're going to break down some of the most effective strategies that you might use to pay off your mortgage. Then we're going to recap some of the biggest benefits of being mortgage free. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree and live financially free. If you like what you hear today, please consider giving us the YouTube triple thanks. That's hitting the like button, subscribing to the channel, and then commenting down below. Thanks for considering it. Here are 6 strategies to pay off your mortgage early. Number 1, downsize or minimize. This advice doesn't necessarily apply if you already have a mortgage, but if you're shopping for your first home or considering moving, you can pay off your mortgage early by buying less house. It's tempting to let the loan approval amount make decisions for you, but just because you're approved for a $500,000 mortgage doesn't mean you necessarily have to buy a house in that price range. Instead, ask yourself how much home you truly need. Tiny home living certainly isn't for everyone. It's definitely not for us, but McMansions don't have to be either. By choosing a house that fits your needs, you can live comfortably without a massive mortgage. Number 2, change your payment plans. Changing up your payment plan might be the jumpstart you need. The most common form of mortgage payments is a monthly payment. However, you might be able to change your payment plan to pay off your mortgage faster. If you make one mortgage payment each month, you're making 12 payments a year. But if you make bi-weekly payments, you're making 26 payments a year. Someone who pays $1,000 a month on their mortgage would pay $12,000 a year. However, if you pay $500 every 2 weeks, you actually pay $13,000. That extra $1,000 might not seem significant, but that's the beauty of it. It comes out of your bank account painlessly, but can really slash away at the life of your mortgage, especially if you have a 30-year mortgage. However, you want to check with your lender to make sure that bi-weekly payments are allowed with your plan. For other homeowners, it might make more sense to continue paying monthly. Monthly payments are convenient because they fit within budgets and they're typically based on a month-to-month schedule. Monthly plans are also familiar for homeowners who recently made the switch from renting, since rent is also always paid monthly as well. To get the full scoop on bi-weekly versus weekly payments, check out this video right here. Number 3, stash found cash. It's easy to fall into the trap of thinking that you need big money to make big progress on your mortgage payoff. This isn't the case. In fact, you can make a considerable dent in your mortgage, $25 or $50 at a time, just like the McNeely family. They crushed over $300,000 of mortgage debt in 5 years, partly thanks to making small extra payments. Whether it was selling items they no longer needed or leftover money in their budget, they transferred the funds to their mortgage. If you find yourself with extra cash anytime throughout the month or at the end of the month, don't hesitate to make an extra payment. You also want to check that you're paying extra toward the principal, not interest. Principal is the outstanding loan balance you're trying to slash away at. You don't want to contribute any extra to the interest. Number 4, refinance for real or DIY. When mortgage interest rates are low, it makes sense to explore options for refinancing your home. You might refinance for a lower rate. So if rates were 5% when you bought your home, you might be able to secure a lower rate of 3% or even 2.5%. You might also refinance for a shorter term. It's true that moving from a 30-year mortgage to a 15-year mortgage will increase your monthly payment amounts likely, but you cross the mortgage finish line years faster that way. Of course, before you move forward with a refi, you want to investigate the costs associated with refinancing. It's also important to consider how long you plan to live in the home after you refinance. Check out a resource like LendingTree or Credible that provides you with competitive rates across multiple lenders. I'll put their links in the description below. Sometimes the costs associated with refinancing don't make an actual refi worth it. That doesn't mean you can't DIY one though. By making large payments each month, you're slashing away at the interest you'd pay over the life of your loan. Number 5, recast your mortgage. If it doesn't make sense to refinance your mortgage, you might consider a mortgage recast. There are definitely pros and cons to a mortgage recast, but it's certainly an under-discussed mortgage payoff strategy. The short and sweet version of a recast is that it's done after you make one large payment toward your principal. Let's say you manage to throw an extra $10,000 at a $100,000 mortgage. Your principal is now $90,000. You can request a recast from most lenders. They will re-amortize your loan at that point. That's just a fancy way to say that they're going to recalculate your payment schedule, usually lowering the payment amount. Whether you decide to refinance or recast your mortgage, you want to reach out to your lender for specifics. This includes fees to see if that decision is worth it to help you pay off your mortgage early. Number 6, scrap PMI ASAP. Did you buy your home with a conventional mortgage? If you put down less than 20%, you might be able to shake off some of that extra cost. PMI, or private mortgage insurance, is applied when buyers fall short of a 20% down payment. It's extra protection for the lender, and it's an extra cost for you. A lot of home buyers simply continue to pay payments, waiting for PMI to be dropped automatically. But you might be able to request to have it removed once you have 20% equity in your home. If that's the case, you can allocate the money you'd normally spend on PMI and put it towards your mortgage principal instead. These are some of the top ways to pay off your mortgage early, my friends. Of course, there are so many different strategies that you can use. You might start with one like getting rid of your PMI and then moving on to another one. With all these strategies to pay off your mortgage early, you might be wondering why more people don't do this. Well, some people are just focused on other goals. For many people, though, they start with good intentions and then they lose their motivation a little bit. That's why a key part of an early mortgage payoff is keeping your why front and center in your mind. Here are some of the main reasons why you might be motivated to ditch your mortgage ahead of schedule. You can invest more. We all know that investing is key to creating your ideal future. Whether you intend to retire at a traditional retirement age or you're on a path to FIRE, you need to invest. But where does that money come from, right? Well, becoming mortgage-free is a powerful way to ramp up your investments. If you normally put $1,500 a month towards your mortgage payments, that's the principal and interest. When you're mortgage-free, you can immediately transfer the money you would make toward mortgage payments to your investments. $1,500 a month adds up to $18,000 a year. That's more than enough for you and your spouse to max out Roth IRA contributions. It also allows you to invest in a 401k up to the company match and then some. Those are huge strides you can take without worrying about cutting more expenses or earning additional income. Becoming mortgage-free can certainly accelerate your investments. While I'm all about mortgage freedom, I know that investing works best when you start early. So ideally, you're investing a portion of your income, perhaps 10 to 20%, as early as possible. After mortgage freedom, you can crank it up even higher depending on your goals. You could also achieve Coast FIRE faster. You already know that paying off your mortgage early means you can invest more. Did you realize that it also puts financial milestones like Coast FIRE within reach much faster? When you hit Coast FIRE, it means that you have enough money set aside in your retirement accounts now that you will be able to retire at the traditional retirement age. Because your overall living expenses are significantly lower when you're mortgage-free, you suddenly need less money in retirement. That means that your overall Coast FIRE number might drop significantly. Even if you don't think your target number will drop, you can hit it faster by investing the money you would normally put toward your mortgage. And then lastly, live your dreams now. Paying off your mortgage means big things for your future, but being mortgage-free should let you dream bigger much sooner as well. Maybe you've dreamt about increasing your charitable giving. One of the first things the Robinson family did with their paid-off mortgage was to increase how much money they donate each year. Perhaps you've been daydreaming about taking a big dream trip. How fast could you build a sinking fund dedicated to travel if you freed up hundreds or even thousands of dollars per month? When the Furons paid off their mortgage earning less than $50,000 a year, one of the first things they started doing was planning family trips. When you're looking at the total money you owe on your mortgage, the idea of paying it all off can feel overwhelming. For most of us, mortgage debt is the most debt we'll ever take out. It's no wonder that people often struggle with ideas to ditch that debt faster. Consider changing your payments from monthly to bi-weekly, or make a move to ditch your PMI. There are so many strategies that you can implement once or on an ongoing basis. That flexibility means you can find a strategy to fit your financial situation. When you do, you'll be mortgage-free sooner than you think. Well, enough from me, everyone. I want to hear from you. Are you trying any strategy right now to pay off your mortgage early? What motivates you to become mortgage-free? Please let us know in the comments below. This is Andy Hill from Marriage, Kids, and Money, signing off. Carpe diem.